Good day, fellow investors. In this video we'll discuss why average investors do very badly and how to avoid it. When we discuss the JPM Guide to Markets, discussing all kind of things from economics, valuation, I'll put the link in the description below to the video. One of the slides is related to 20-year annualized returns by asset class. And apart from all the asset classes there is also this. The average investor, on average, this is data by Dalbar. So looking at aggregate mutual fund sales, redemptions and exchanges each month as a measure of investor behavior, they came to the conclusion that the average investor did an average return of 2.9%, while the S&P 500 did 7.5%. That is a staggering difference. And if we go to the investor government compounder calculator, if you started with, let's say, $1 million, no contributions, 20 years, interest rate, let's say the market did 7.5 and you did, the variance was 4.6, and if we calculate, here are the results, and the market 1 million became 4.2 million, the average investor became 1.7 million. That's a staggering difference, and that's something you as an investor want to avoid. Of course, if you did 12%, you did a lot better. So why average investors do that badly? Well, in the Seth Klarman video from last week, we discussed the following. Flows of funds. Investor added more money to the stock market now than in the past 19 years. So investors added more to the stock market now 2021 than in the past 20 years. So not here. God forbid you buy when it's cheap. Investors added money now. And if we look at when investors take out money, look at here the crash. So they removed money from the market. Things with China, what was going on there, European crisis, budget crisis, great financial crisis. So investors simply like buying when things look great and are expensive and selling when things are bad. That's the first thing not to do. Plus, of course, investors like buying when it's expensive. So now that the price-earnings ratio is one of the highest in history, now people buy like it was the case in the 1990s, like it was the case in 1929, 1968, and returns since then, especially adjusted for inflation, have been pretty bad over the subsequent times. And the problem is that people like buying here and there are either forced to sell here or panic and sell over time instead of looking at the fundamentals and owning businesses. And now I hear on the radio there are constant promotional messages from investment funds. Now you have to invest. My family, now they want to invest because inflation is starting to bite. You see, okay, I was a saver, I lost 50% of my purchasing power over the last years, and that simply hurts, and now people want to rush into the market. How to avoid it? Well, it's very difficult to avoid it. We discussed whether to sell everything or not, but if you are investing, the first thing you have to do is be prepared for adversity. Adversity is normal when it comes to investing. Stocks go up and down, up and down, up and down, and if the next trend is for 20 years of down, you have to be prepared for that, because then you buy over time and you get good returns, and also you are focused on what you are buying. If you just follow the herd and just buy when things look great and don't expect adversity ahead, then that is the first reason why you might make mistakes over time. Of course, avoid leverage. This is from Seth Klarman's guide, How to Invest in 2022. So avoid leverage, because if that goes against you, you're dead. Of course, limit portfolio duration, but that's something specific to Seth Klarman. And then The key is to focus on the downside. Okay, what can go wrong in my portfolio? What happens to me if it goes wrong? And can I handle it no matter what? If you can answer that questions, I guarantee you, you will be better than the average investor. Seth Klarman also says to actively manage a book of hedges, but I would like to change that because that's hard for our retail investors, into invest in businesses. And if you start investing in businesses, then you have the following advantage. When Jeff Bezos spoke to Warren Buffett, Warren, your investing strategy is so simple. Why doesn't everyone just copy you? And the answer was staggering, because nobody wants to get rich slow. And if you want to get rich slow, there are plenty of ways to do that over time, and you don't have to chase the trends. For example, one of the stocks that Warren Buffett recently bought in 2020 is Verizon. Slow company, stable company. There is a little bit of debt, but Warren Buffett backing it, so the debt might be mitigated. It's a good dividend, good position in the market, and it's even cheaper now than what Warren Buffett paid. Of course, it's boring, it pays a dividend, that's it. Will you get rich fast on a dividend payer? No, but you might want to get rich slow, and if you're happy with a dividend like this, then you are investing in businesses. And there is a video of me of Verizon. I'll put the link in the description below. How to apply that to the current market? Well, if we look at the US, then the US market with 20% of GDP is 61% of the global market. So it might be risky from a valuation perspective. As we discussed, Jeremy Grantham is calling it a super bubble. And you want to avoid being stuck in something that will go down or has the possibility to go down for the next 20 years. Or you want to be compensated for the risk by having a good dividend, which the current market doesn't have. And perhaps the best message I can give you not to be the average investor is to accept that there can be adverse times ahead. And if you accept it, that becomes your opportunity. And then you start thinking, okay, investing is a process that I have to do over a lifetime. So we are now at the peak, maybe we'll see a crash down the road, maybe not, but if you accept it, that it is a long-term cycle, that you build and compound wealth, dividend after dividend, paycheck after paycheck, then whatever happens, you're okay. But you will get rich slowly, and I can guarantee you that you will get rich if you start thinking like that. But you have to see, and let me know in the comments below, whether you're okay with getting rich slowly or you want to get rich fast and invest in the Teslas of the world. If you enjoyed this video, smash that like button.